Welcome to our 2022 webinar series, Risk Management with Insurance in a Post-Pandemic World. The COVID-19 pandemic taught us to adapt and accelerate trends socially, technically, and environmentally. As we inch into a post-pandemic world, risk management continues to be top of mind for most of us. Each month, you'll learn about insurance solutions you and your clients can consider, plus the significant impact to insurers and their post-pandemic strategies. Each webinar will last about 50 minutes, and you must be logged on for the full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them into the questions box. Today's webinar is being recorded and will be posted on our website within the week. Today's presenter joined LLIS in 2008 and has over 20 years analyzing, studying, and researching annuity solutions. Here to share all his knowledge for Annuity Awareness Month is Jerry Skapiak.
Thank you, Claudia. All right, so today we're going to talk about annuities. We're going to break this up into like two different parts. First, we're going to talk about some basic annuity stuff, and then we're going to go into when I'm reviewing annuities for you, kind of like the steps I'm going through, things I'm looking for, to give you a little bit more understanding of kind of what's going on behind the scenes. So, but first, the types of annuities we're going to talk about. We're going to talk about fixed deferred annuities, immediate annuities, deferred income annuities, qualified longevity annuity contracts, and we're going to touch briefly on indexed annuities. So let's start by talking about fixed deferred annuities. So with a fixed deferred annuity, what you're getting is you're getting a guaranteed interest rate. Think of like a CD. So you're going to get a guaranteed rate for a set number of years, and that number of years can be anywhere from 3 to 10 years. There may even be some that will go maybe a 2-year annuity out there, or some that may even go longer than 10 years. But typically what we're working with here is going to be 3 to 10 years. There are surrender charges on them, even though we have some low load annuities available for fixed annuities. They still all have a surrender charge. There is no way to get around that with those products. And most will allow you to withdraw some amount out penalty free during that surrender charge period. So it could be 10%, 15% a year, or maybe the prior year's interest. Just depends on the annuity and what they're offering. So what is the surrender charge on a fixed annuity? Well, it's basically being used to reimburse the insurance company their costs for getting the annuity issued. So what it's doing, it's going to reimburse them any commissions paid, and it's going to reimburse them for underwriting expenses. Now, a lot of times when you're thinking of insurance products and underwriting, you're thinking of health underwriting, but with annuities, they're looking more at financial underwriting, and what that basically means is suitability. They're doing their due diligence to make sure that the annuity the client is purchasing is an appropriate investment for them. And then normally these surrender charges are decreasing. They'll typically decrease by 1%. Some states do it, of course, insurance companies that do it a little bit different. So you may see some surrender charges like 7.2% in a year. But most of the time they're decreasing by 1% every year. Taxation on annuities. So gains are tax deferred in the annuity. So that's one of the benefits. They're treated like retirement accounts. Any growth inside of annuity is going to grow tax deferred. But any withdrawals taken from an annuity are LIFO. So those gains are going to come out first. And those gains are going to be taxed as ordinary income. Now, like retirement accounts, if the client is under 59.5, there is going to be that 10% penalty on any gains that are withdrawn out of the annuity. So this week, this is like actually as of yesterday, I don't believe rates have changed today yet, but this is the current rates. By far the most popular rates we've been seeing right now that advisors are using for their clients is the 3-year and 5-year rate. Those are up, I believe, over 1% so far this year, all these rates. So they are moving up nicely, and we have definitely been seeing more interest from advisors, especially with what's going on in the bond market. You can look at fixed deferred annuities and get the clients a guaranteed interest rate without any risk of loss of principal due to changes in current interest rates. So, I mean, that's really it with fixed deferred annuities. They're very simple. Um, and we're going to talk about immediate annuities, and in my opinion, immediate annuities are just as simple as fixed deferred annuities. So, a common question I get asked all the time is, how much guaranteed income should a client purchase? Well, basically, they should look at covering their fixed expenses that they're going to have in retirement. So they want to make sure they're going to cover the mortgage, cover electricity, their utility bills, the water bill, groceries. I can't forget about insurance premiums. They're going to have their supplemental insurance in retirement, but basically look to cover that fixed expenses they're going to have between Social Security if they're fortunate enough to have a pension. And if there is still a gap there, maybe consider using an immediate annuity to help cover those expenses. So with immediate annuities, there is a variety of payout options that are available. So you can do a period certain, so it's a non-lifetime payment, or you could do a lifetime payment for your clients. So with a period certain payment, so we'll use simple examples. Let's say you do just a 10-year period certain. What that means is that annuity is going to make payments for 10 years and then stop. If the client passes away before they receive all 10 payments, the payments will continue to a beneficiary until those 10 payments have been made. As I said, the annuity is going to be guaranteed to make the number of payments that it was purchased to do. Where we see period certain annuities used most often is that Social Security bridge. So your client retires, they're not 72 yet, and they'll purchase a fixed period certain annuity to bridge that gap until Social Security will start. But what's the most common type of payouts is lifetime payouts. A life-only payout is going to give you the highest payout. There's no guarantee on it. The annuity is going to make payments as long as the client's alive. Once they pass away, payments will stop. Now, a lot of clients get scared with that, so there are different guarantees you can add on to an annuity. You do life and a period certain annuity. So going back to our example, a client purchases a life and a 10-year period certain. That annuity is going to make payments as long as that client's alive. If they pass away before the 10-year period is up, so let's say they pass away in the 8th year, that annuity will continue to make payments for the next 2 years to the beneficiary, fulfilling the period certain part of that annuity, so that 10-year period certain. But if the client lives a long life, that annuity is going to continue to make payments for as long as they're alive. The next two payments are my two favorite, the life with installment refund, life with cash refund. What these two payout options do is they guarantee that the annuity is going to pay out at a minimum the premium that was put in. So let's say the client puts $100,000 into the immediate annuity, they're receiving payments, they pass away after receiving $75,000 in payments. The installment refund option will continue to make payments to the beneficiary until that other $25,000 has been paid out, whereas the cash refund option will just simply write a check to the beneficiary for that $25,000. Of course, if the client lives beyond receiving $100,000, annuity will continue to make payments to them. That's what the life part of that does. And here's where current payouts are. We have Deborah, who is age 71. She writes a $200,000 check for an immediate annuity. And we can see the payouts. Life only is the highest payout. And as the guarantees get longer, the payouts go down a little bit. Also, you'll notice we have an exclusion ratio on here. I'll get back to that and touch on that a little bit more, exactly what that is. But typically, this is where payouts are. Payouts have went up quite a bit, especially in the last couple of months with the rising interest rates. When I was updating the slide, I actually had quite a few of these numbers were not even payouts were not even $1,000. Now, as you can see, they're all over $1,000 now. So that's a positive thing to see with the immediate annuity payouts. Now, we talked about just like an individual life-only payouts, but you can do an immediate annuity as a joint life. So even if you have a client who has an individual annuity that they own right now, you can do a tax-free 1035 exchange into immediate annuity and add the spouse on and receive joint payments based over both their lives. You can reduce payments upon the death of one of them. That is an option. I say we do maybe one of those a year where we do that. Typically, we're doing 100% joint and survivor. So when one spouse passes away, 100% of the payments continuing to the surviving spouse. So we have Charles, age 66, Sandra, age 64. They're writing a $200,000 check, and here are the payments. So one of the things you'll notice on here is that the joint life only is the lowest payment on here. Now you're probably thinking that's kind of strange. In the insurance world for the last few years, it is not strange. What was happening is insurance companies were getting sued by beneficiaries. Their parents were taking, say, life-only payouts. Maybe they had some health issues. They didn't live very long. And the beneficiaries were like, wait a second, this is not a suitable investment for my parents. They only received $50,000 of this $200,000. They should have never bought this immediate annuity. They would have been better off just taking the money out of the account. We're suing you for that other $150,000. So what insurance companies did is they just altered the payouts to entice clients to not do life only and to really, as you can tell, do a joint life with a 10-year period certain. So typically, it's not uncommon to see this. Now, when we start getting older clients, that 10-year certain may not be the highest, but it will be still very close to the joint life, still enticing clients to do that joint life and 10-year period certain. So going to the exclusion ratio. So the exclusion ratio is the exception to the rule for annuities where when taking money out of an annuity, the gains come out first. With an immediate annuity, when you annuitize it, it's going to spread those gains out over the insured's lifetime. When I say insured's lifetime, that's what the IRS says their lifetime is. And so what happens is each payment is then part cost basis, which is going to be tax-free, and then part gains, which will be taxed as ordinary income. So what will happen is if your clients live a long life, they're going to receive payments and they're going to have this exclusion ratio, but at some point they're going to basically receive all of their cost basis back, meaning that every payment going forward is going to be technically all gains and will become fully taxable to them. So immediate annuities, they do have some limits on them, meaning that insurance companies are not going to allow a client to put more than 50% of their non-qualified money into an immediate annuity. And when I say non-qualified money, that means 50% of their investable assets. If it's qualified money, if we can come up with a good reason, some insurance companies will allow more than 50%, but they really like to stick to that 50% rule. So that's just something to keep in mind. Even when you get the clients that you're doing a pro bono case for, they only have $100,000 on paper. It makes perfect sense to put all $100,000 into an immediate annuity to give them income for the rest of their life. The insurance company is going to say no. The max you can do is $50,000, because what the insurance company is worried about is if they have unexpected expenses come up, they no longer have access to any funds to cover those expenses. So in a way, it's really the insurance company protecting the clients from themselves. So that's it for immediate annuities. Another product that's becoming more popular right now, the deferred income annuity and the qualified longevity new contracts. And these are slowly becoming more popular because interest rates are going up. So, what is a DIA or a deferred income annuity? Well, it's a cross between a deferred annuity and an immediate annuity. It's going to insure your clients against living simply too long in life. And it's usually used as a supplemental to retirement solutions. So, what are the features of a deferred income annuity? They're single premium, uh, guaranteeing future income streams. So, payments have to start 2 to 30 years in the future. That first payment cannot be deferred any longer than age 85, and actually, age 85 is the most common age where that first payment is deferred to. Um, Payout options are pretty much all the same as what you would see with a regular SPIA immediate annuity. There are no lump sum payouts out of it, so you're going to receive an income stream from this annuity. You can add on a death benefit uh, to these, and what that simply means that if the insured dies before payments begin, beneficiaries will receive the original premium back, and taxes are due to the owner when payments are received. So you have an exclusion ratio for non-qualified money, just like we had with immediate annuities. With qualified longevity annuity contracts, QLACs, they are also single premium, but there's a limit to how much you can put in. So you can put up to 25% of a client's qualified assets, not to exceed $145,000, and Roth money is not counted toward this and is not eligible to be put in. You have the same deferrals that we have with DIAs. Our payout options are limited to either life only and life and cash refund. You can still defer up to age 85. And then with taxes, and this is where the DIA I see being used the most, is that the money that's put into a QLAC is excluded from RMD calculations for the client. So you can take $145,000 of a client's qualified money, and that's going to be excluded from future RMDs the client has to take. So you got a client, they have all sorts of income coming in retirement, and now they have to start taking RMDs, just giving them more income that they don't need. They don't need to spend it. It's a way to help reduce some of that income and give them a nice bump in income in retirement later on. So here's an example of payments. Here we have Jeffrey, age 65, $100,000 premium. We're going to begin monthly payments at age 85. As you see here, with a single life with a death benefit. So what this means is that if he passes away before age 85, his beneficiaries would receive the $100,000 back. His payout would be $3,451. Without a death benefit, payments quite a bit more, $4,279. And as you can see, we can add on period certains, the cash refund option. All of those can provide some guarantee to the client. I will tell you this, a lot of times some insurance companies, when you start adding on a guarantee, they will automatically say you have to add the death benefit onto the annuity. But not every company's like that. It just depends on the company and how they're going to run the business as far as QLACs and DIAs are concerned. But here's, like I said, this is a nice example. These payments also have went up quite a bit. This product is extremely interest rate sensitive because we are deferring those first payments so long. And then we're going to talk briefly now about index annuities. So with index annuities, for those of you who have worked with us, know that we are not exactly fans of indexed annuities. To us, they're more complicated than a simple variable annuity is to a client. We've also have seen some very bad illustrations, and we're going to actually go over one just as an example in this section. But with index annuities, the sales pitch is very simple for these. Uh, the agent goes to client, how would you like to participate in all the market gains and never have to participate in the downturns of the market? And that's what gets a lot of clients hooked on them. So within index annuity, the performance is tied to particular index. They're not actually invested in the market, even though they're buying that they believe they're buying, like say an S&P 500 index. Um, Common would be the S&P 500 is by far the most common. There are caps on these indexes, meaning there's like a maximum interest rate they can use. Now, there are some newer index annuities out there that have removed the caps, but just when you start doing all these little tweaks to these annuities, they become even more complicated. And most clients can't describe what a basic annuity is, let alone when you start adding on all these hybrid type designs in these products. And then these annuities often have a floor of 0%. There are some annuities out there now index annuities, that you can even lose some money in it. When the market's doing great, they're very easy to sell because no one believes the market's ever going to go down. Right now that we're in a down market, I don't know how well some of those annuities are going to be selling. But here, this is a proposal that we saw back in 2019. As you can see, the floor was 0%. It had a cap of 6.85%. What's very common with index annuities is they'll show you the last 10 years. There's also an option to when you're running these illustrations, show the best 10 years, show the worst 10 years. But what we have here was the last 10 years at that time. It just also happened to be the best 10 years of the S&P 500 index. Oops, sorry, silenced everything. And as you'll see here, this is why clients are looking at this. So in 2011, 15, and 18, there was basically zero to negative return in the market. Which they didn't have to participate in. But when you look at, like, example, 2017, the market returned 19.41%. They only got 6.85%. So in the end, after this 10 years, they earned $159,000 in this annuity for a $100,000 investment. Not so bad, but had they simply just purchased the S&P 500 index, they would have had over $270,000 in their account. Now, something else with these index annuities is, like, especially with the S&P 500, they don't get to participate in the dividends of the S&P 500. And from what I've been told, about a third of the return for the S&P 500 is the dividends of the stocks that are held within it, and they're not able to participate in that. So if we look at the flip side here, we look at the same proposal, the worst 10-year period. Look at 2002, we had a negative 23, which they didn't take any loss that year. But 2003, the market went up 26%. They only got their 6.85%. But had they been invested in an S&P 500 fund, they would only have $73,000. So there's pluses and minuses to these clients. If you have an extremely conservative client, the index annuity is not a bad option. You can tell the client, you know what, you're never going to lose any money in this, but we're going to be able to participate in some of the market growth. I will tell you right now, some of the index annuities I've been seeing, their caps are set at 3%. So they're fairly low. It just depends on the annuity. Index annuities. So, they're going to protect against that downside, which is why clients purchase these. But they need to read the fine print of these illustrations. Here's like the footnote that was on this annuity. It's likely that such performance will not repeat. We all know that past performance is not a guarantee of future performance. The 1 year point-to-point strategy with a cap have a minimum cap guarantee of 1.1% for the contract duration. So what was very interesting with this, and a lot of advisors don't understand this with index annuities, is that when this illustration was run, the cap was 6.85. Client went back, made a couple tweaks to the illustration. The cap had already been reduced on it to 6.65. So what advisors and clients don't understand is that if they're doing like an annual point-to-point index option, which means they're literally the annuity is going to look at the that day the money went in, what the S&P 500 is, and then 1 year later what the S&P 500 is. That's what's going to calculate their growth, and they're going to pay up to the cap. If it was negative, they're going to give them 0. But what clients don't understand is the insurance company is going to adjust that cap every single year. So they may think it's going to stay at 6.85%, but next year when they renew it may be lower. There's not much incentive for insurance companies to keep the caps very high with these products, which is what we've seen. And this is kind of what we're talking about. What is it going to be next year or in 5 years, the caps? So that's kind of it on these annuities that we're going to touch on. So we're going to see if there's any questions. All right. So what we're going to spend like the rest of our time on is talking about annuity reviews. I do almost one annuity review every day for advisors. So there's a few things we look at. I look at what's the surrender charges on the annuity, is it qualified or non-qualified, what's the cost of the annuity, what's the client's age, is there a death benefit or income rider on it, and that's actually where the vast majority of my time is spent in reviewing annuities. And then what's the recommendations for the annuity? So the first thing we're going to talk about is surrender charges. So once again, typically all annuities are going to have surrender charges, especially ones that your clients are bringing to you. If there's a surrender charge still on the annuity, there's not really much that can be done until it's out of surrender charges. If there's no surrender charges, we typically move on to step 2, looking at is it qualified or non-qualified. If it's a qualified annuity, I don't like seeing this, especially for deferred annuities, because now we're using a tax-deferred annuity in a tax-deferred account already. They're paying all these fees for the annuities already in an account that's already tax-deferred. So typically, when I see a qualified annuity, the recommendations is very simple. Once the annuity is out of surrender charges, if they're not going to use that annuity for income, move it to an account that you can manage for them. If they're going to use the annuity for income, and there's nothing wrong with using qualified money to purchase an annuity if it's going to be used for income, then we need to look at and see, does an immediate annuity make sense? We're going to talk about income riders in a little bit. If there's an income rider on that annuity, it may be a good thing that the client has it. Every annuity, every situation is different. We talked about that. If it's non-qualified, well, we need to determine what's the overall objective of the annuity. If the client's in a top tax bracket, well, the income deferral may be the reason they purchased it in the first place. It's the only time that I really see or ever really recommend someone putting money in a non-qualified annuity is if they're already maxing out their 401k, their health benefits, and then they can still benefit from tax deferral. Then it might make sense to look at a non-qualified deferred annuity. Or the overall investment strategy makes tax deferral attractive to them. So there are some situations when a client has a tax deferred annuity, it may make sense for them. And then go back, and then we want to take a look at the basis on the annuity. And it's basically, I'm going to take a look at like how much money did they put in the annuity, what's the value of the annuity now, and let's see what we can do. So if it's an even basis, so there's like no tax or a small tax hit, so there's a small, maybe a little bit of a gain in the annuity, just surrender the annuity. I once had an advisor, there was a $2,500 gain in an annuity, and they wanted to do a 1035 exchange to avoid the client having to pay taxes on $2,500. And I had to talk to him. You're going to have the client go through all this paperwork and all of this to avoid paying taxes on $2,500, and you're going to still leave the money inside of an annuity. This is a perfect opportunity to get them out from underneath the umbrella of an annuity with very little tax hit. If there's a large basis in the annuity, so a simple example, let's say the right now, if someone purchased an annuity a year ago, odds are that the value of the annuity is going to be less than what the original premium was put in. Of course, talking about a variable annuity in that kind of situation. Um, you want to wait for the value of that annuity to grow and get up to the cost basis. If you surrender an annuity and the annuity's in a loss position, um, the client more than likely cannot write off that loss. Typically, you cannot write off losses for insurance products on your taxes. So what makes sense is, well, let's keep the annuity, let it grow up to that original cost basis, and then surrender it. Because you're going to get free gain that's, in a sense, tax-free to the client at that point. Let it grow up to the cost basis. Now, what I actually see more often than not is where we have a small basis and a large gain in the annuity. And that's when we're going to move on to step 3. So what's the cost of the annuity? So if it's a variable annuity, there's going to be a variety of charges. You're going to have mortality and expense charge, you're going to have an administration charge, and you're going to have sub-account fees tied to it. If it's an index annuity and it has a rider on it, you're more likely going to have a rider charge, just like you would with a variable annuity. So we got to take a look at what are the charges of the annuity. And step 5, looking at client's age. We kind of touched on this already. If they're under 59 and a half, surrendering that annuity, they would pay a 10% penalty on any gain. Once again, if it's a small gain in the annuity, it's worth paying it. You know, if it's a $2,500 gain, they're going to pay, I believe, what is that, $250? It's worth it to pay that and get out from underneath the umbrella of an annuity. But some annuities will have a death benefit rider, and a lot of annuities will have income riders on them. So this is where it pays to have an annuity evaluated, and just don't go out and automatically assume to surrender an annuity. If your client is unhealthy, that annuity is going to have a death benefit first off. The death benefit, basic death benefit on an annuity, is going to be the greater of premiums paid or account value. There are annuities that offer enhanced death benefits, so where that death benefit could be even higher than the account value. So here's an example. Original annuity has a basis of $100,000. Current value is $200,000. The death benefit's $250,000 on the annuity. So at death, the beneficiary could get $250,000. $100,000 of that will be tax-free, and $150,000 is going to be taxable to them as ordinary income. It's much better than if they had went and surrendered the annuity and handed the client $200,000 with no death benefit. They'll end up with more money. So you got to look at, see if the annuity has a death benefit on it, and then also take into account client's current health situation. It may be beneficial hanging on to that annuity if it has a nice death benefit. But in the short term, that's something that needs to be reevaluated all the time. Because as that account value grows, that death benefit may become smaller and smaller and become not as beneficial as it originally was when you first looked at it. But income riders, this is the most popular thing I talk about with annuities. Let me see, I got a question here. Why exchange qualified annuities to another qualified annuity? That would be if you're looking for income. So let's say the client has a deferred annuity. Let's just say it's a simple variable annuity, and they want income for it. It's okay if it's qualified to transfer that to an immediate annuity that is also qualified. Typically, I don't recommend taking qualified money and buying deferred annuities, but immediate annuities is perfectly fine. You're going to have clients coming to you that the vast majority of their money is only going to be qualified. And if they can benefit from a guaranteed income stream, you got to use that qualified money to give that to them. I got someone asking what has been the 2022 return on Voya index annuities. We don't work with Voya index annuities. I'm sorry, I cannot help you with that. All right, and let me see if there's any other questions. I like to answer these as I go along. Um, that's it. All right, so let's go on. So income riders, like I was saying, this is the most popular part of my presentation. This is where I generally get the most questions, and it's the most interest. So when looking at the annuity, does it have an income rider? If the answer is yes, it needs to be reviewed. There are so many different income riders and different twists to them. Yes, a lot of them basically work the same, but there are some nuances that make them all different. I came from a home office. Granted, that was 20 years ago when income riders were first kind of coming on the scene. And I know back then insurance companies were trying to patent and even trademark their income riders. So there's a variety of income riders, or basically three main income riders that are on annuities. Guaranteed Lifetime Withdrawal Benefit, or GLWB, is by far the most popular. Next is a Guaranteed Minimum Income Benefit, GMIB, made popular by MetLife. I see a couple other insurance companies use it every now and then, but primarily that's a MetLife rider. And then a Guaranteed Minimum Withdrawal Benefit, GMWB. Don't really see that anymore. That I see mostly on some older annuities. So let's look at the basics of income riders. So we're going to use an example, and we're going to use this example throughout the process of talking about these income riders. So when we're looking at an annuity that has an income rider, there's going to be two numbers on a statement. You're going to have the account value. This is the cash. This is the real money. This is their money that's in their pocket. Then there's this benefit base, what I call the funny money. It's the value of the rider. It's a separate number on the statement. So we're going to use a simple example here. We got a client, they want to invest $100,000 into annuity, and they're coming to you saying, hey, I got this great investment. I'm told I'm guaranteed 5%. So what is guaranteed 5%? Anytime you have a client coming to you, it's a variable annuity, index annuity, they're telling you they're guaranteed some rate of return. What they're telling you is that it has an index, or it has an income rider on it, and they're telling you what that index or what that rider is guaranteed to grow by. They don't remember everything else they're hearing. And it may be 5%, 6%, 7%, 10%. It just depends on the annuity. So clients can invest $100,000. End of year one, the account value grows to $103,000. But wait, we're guaranteed 5%. And that's what that benefit base, that money is going to grow by. So it's going to be worth $105,000 at the end of year one. Year two, annuity does great. The account value grows to $120,000. Their benefit base grows by the 5%, so it grows to $110,250. One thing that's really nice with these income riders is that they have what's called a step-up feature. And what it does is it says on the policy anniversary, and there's some annuities that do it monthly, some do it quarterly. There's even an annuity out there that does it daily. But we're going to use policy anniversary to keep it simple. It's going to look on the policy anniversary, is the account value greater than the benefit base? If it is, that benefit base is, in our example, is not going to be $110,000. It will step up to equal the $120,000. It's a nice feature with these riders. Year 3 comes along. Account value goes down. It goes down to $80,000. Not a good year for the annuity. But we're still guaranteed our 5%, so our benefit base grows to $126,000. Okay, so here we are, end of year 3. We got an account value of $80,000. We got a benefit base of $126,000. Client says, you know what? I've had enough of this annuity. I want to take my money and run. I want my $126,000. I'm going to go do something else with it. Well, unfortunately, that's not what they get. $126,000 is only used to calculate income. That's why I call it the funny money. It's just a number on the statement. It is nothing more. It's just used to calculate income. So, with our income riders, we got to make some distinctions here. So, a GLWB, guaranteed lifetime withdrawal benefit, is not an annuitization. The GLWB is going to allow the owner to withdraw a certain percentage of that benefit base for life. It's a withdrawal benefit. It is not annuitization. When you annuitize an annuity, you're handing over all the money to the insurance company. It's an irrevocable decision, and that insurance company is going to guarantee to pay the client a set amount of money every month for as long as that client's alive. GLWB, you still maintain control of your money. You always have access to it. Annuitization, you give up control. The GMIB has 2 options. It allows the owner to withdraw 5% of the benefit base for life, or they can annuitize the benefit base for a higher income, but they're going to give up control. So let's talk about the GLWB. Like I said, that is the most common one. Typically with a GLWB, you're going to be able to withdraw a certain percent based on the client's age at the time of that first withdrawal. If it's a joint annuity, it will be based on the age of the younger of the two. So in our example, we're just going to keep it simple. We're just using an individual. They're going to take their first withdrawal at age 70, and the annuity is going to allow them to withdraw 5.25% for life. So going back to our example, we have 80,000 account value, 126,000 benefit base. They're going to be able to withdraw 5.25% of that benefit base, getting $6,615 a year. But remember, you can't have both. You can't have this nice income of $6,615 a year and take additional money from the annuity above that amount. So here it is, just simply illustrated. Remember, we're keeping numbers simple here. We're not factoring in any growth on the annuity. I just want everybody to understand how this works. So starting in year 4, we're taking our $6,615, and that's going to be subtracted dollar for dollar from our account value. And this is going to happen every year. And as you see, when we get down here to year 16, our account value has been withdrawn. There is no longer account value in the annuity. So if we go back up here to year 10, we take our $6,615, client passes away, beneficiaries would receive $33,695. We get to year 16, they pass away, the annuity is going to end, there's no money in the annuity to pay that beneficiary. But Anybody who has an annuity, and please take this away from this part of this presentation, anybody who has an annuity with an income rider, they want to be able to live long enough to reach this point in the annuity where they are receiving income for life and they've taken all the money out of the annuity. The reason for that is these writers have a fee. They've paid this fee for years, 20, 30 years in these annuities. Why? For this point in time to withdraw all the money out of the annuity and to continue to receive income. That's why they're paying all these fees. So if you notice, year 20, they're still receiving their $6,615. The annuity is guaranteed to pay as long as they're alive. But if your client's goal is not to spend all the money in the annuity, then they are in the wrong product. They should want to live long enough to spend that money. Also, because that is the goal, it is better for clients to start income earlier rather than later. So hopefully they live long enough to spend all the money out of the annuity. All right. So now, as I was saying, clients have access to the cash value of the annuity, but you can't have both. So what happens if the client withdraws more than the lifetime withdrawal of the annuity? So going back to our example, we got an account value of $80,000, a benefit base of $126,000. Let's say the client wants to withdraw $40,000. They want to go put $40,000 down on a brand new Mercedes AMG. They can. They absolutely can withdraw that money out of the annuity. But any withdrawals are going to be proportional. So if we're withdrawing 50% of the account value, we're going to reduce our benefit base by 50%. So going back to our example, year 4, we didn't take $6,615 out. We actually took $40,000 out, reducing all of our numbers down. Now we're not getting $6,000 anymore a year. Now we're only going to get $3,308. This is where I mean you can't have both. You can't have access to that money and maintain that income level. And it works the same. We get out 20 years. All the money's gone out of the annuity, but they continue to receive the $3,308. Let me see. I think we got some questions here. Let me take a look. Are all these options available as a fixed or variable annuity? Yes, they are. What are some of the considerations as to whether or not to annuitize a deferred annuity? So where that comes into, it kind of comes into one, when you annuitize, you're going to get your client more income. Immediate annuity provides the highest level of guaranteed income to clients. So if the client's okay giving up control of the money and possibly not leaving anything to beneficiaries, then annuitizing is good. If the client has an income rider on the annuity and they're okay receiving that income that they'll receive from that income rider and not have to give up control and will still may have some cash value to pass on to beneficiaries, then it might be better for the client to keep the annuity and use the income rider on it. All right. And then what is the ballpark amount for fees paid for these? A common fee for an income rider that I'm seeing is going to be somewhere between 90 basis points and 125 basis points. You know, there are some that are going to be a little lower. There are some that are going to be more, but that's kind of where I'm seeing fees as I'm reviewing these annuities. All right. The second most popular, the guaranteed minimum income benefit, or the GMIB, once again, was made popular by MetLife. It gives you two options. You can withdraw up to 5% of the benefit base for life, works just like a GLWB, or you can annuitize it, give up control of the money, no access to account value, but you're going to receive more income. So we're going to go back to our option. We've got our 80,000 account value, 126,000 benefit base. We're going to receive 5% of that. They're going to get 6,300 for life. Option two, they can annuitize it, but now there's like some restrictions on it with these riders. One, they have to wait 10 years before they can annuitize it under the rider. If they typically with the step up on these riders, they're elective. They don't happen automatically because if you elect to take a step up, you start that 10-year waiting period again. And what's kind of hidden in the prospectus on these, they have an age setback. So when you annuitize money, the older you are, the larger your payments are. So what typically I see with these riders is they do an age setback, making the client actually younger when they're calculating annuitization, meaning they're lowering the payouts a little bit more. And this number is not going to be on the statement. You have to call the insurance company to see what the payouts will be. But in an example, going back to our 80,126 benefit base, if they annuitize that benefit base, they would get around $7,056 roughly if they were to annuitize it. So you're going to get more money, but once again, you're giving up control. It just depends on the client situation, what's going to be best for them. All right, the guaranteed minimum withdrawal benefit. Remember, I said I haven't seen a new annuity with these. I normally see them on older annuities, and even that, it's far and few in between. So what these do is they guarantee the client will get back the greater of their principal that they put in the annuity, so the original premium or the benefit base. They can withdraw up to 7% of that benefit base per year. There is no lifetime income on these and no guaranteed 5% growth. So we're going to go back to our original example because the numbers come out a little bit different when we're looking at this one. We still have our same $100,000 we're going to put in. Our account value, once again, at the end of year 3 was $103,000. Our benefit base is going to be $103,000. Year 2, account value grows to $120,000. Our benefit base gets that step up to $120,000. Year 3, account value went down to $80,000. Our benefit base is just going to stay at the $120,000. We don't get guaranteed growth on it. So here we are, $80,000, $120,000. They're going to take their income. They're going to get 7% of $120,000. They're going to get $8,400 a year. But that is not lifetime income. They're going to get that for 14.2 years. So that's kind of the downer with these. But for some clients, that may work. If a client's, already 70 years old, that's going to get them to 84. They're kind of hitting life expectancy at that point. It may be good. It may be good enough for them. And you can invest money other ways to help, ensure if they need income beyond that 14.2 years, they can have it. So once again, this is just illustrating again how it happens when we get down to year 20. You see, we only get 2,400 because that brings our total withdrawals up to 120,000, and then the annuity stops. So recommendations on annuities. So here I go. I review all these annuities, but it comes down to what should the client ultimately do with the annuity. So if they have a qualified annuity and there's no income rider on it, roll the value annuity to an IRA once the surrender charge period is over. You can manage that money. No reason to keep it in an annuity and pay the fees. If it has an income rider, if the annuity will be used for income, well, they may want to keep it. We've already talked about a couple of examples here where it might make sense to keep the annuity. And if the annuity will not be used for income, then roll the value to an IRA where you can manage it for them. Non-qualified annuities, no income rider and only a little gain on it, surrender the annuity once the surrender charge period is over. Get them out from underneath the umbrella of an annuity. Little gain or loss with an income rider, well, if they're going to use the annuity for income, it may be worthwhile keeping. I know advisors don't like hearing that, but it may be beneficial to them. None of us would have recommended the client purchase the annuity in the first place, but they have it. It's the cards that you're dealt when they walk in the door with the annuity, it may be beneficial to them. But if they're not going to use it, even if it's got an income rider on it, they're not going to use it for income, get rid of it. They'll pay the gains on the taxes on the gains. Non-qualified annuity with a large gain. This is where, once again, where I see mostly, um, they can annuitize or transfer it to an immediate annuity. You're going to get the exclusion ratio then. You could do a tax-free 1035 exchange to a no-load annuity. You could do a 1035 exchange to a fixed annuity. So let's say they're tired of the ups and downs of the market. They just want some level growth. You can go to a fixed deferred annuity. Or you could even look at a hybrid annuity with a long-term care rider on it, if they have a need for long-term care coverage. If there's an income rider on the annuity, well, once again, you may want to keep it. It may be beneficial to them. It depends. All right, so we covered a lot of things here. Let me go back here. I think I got some other questions here. Are the costs higher for GLWB than fixed annuities? Well, typically a fixed annuity is not going to have any cost in general by themselves. It's when you start adding riders on them that you're going to have costs added to those annuities. The GLWB, like I said, it doesn't matter if it's variable or an index annuity. The costs are going to be somewhere between 90 basis points and 125. And someone's just asking what's the general ballpark fees for annuities in general. It depends. If we're looking at full commission annuities, it's a variable annuity. You're going to be around 100 basis points, up to 150 basis points, depending on the annuity. Plus, you got to add sub-account fees. Average in the industry is right around 1%. Like I said, index annuities, they don't have those fees. You're just going to have the fees for the riders, and that would be on top. Why do 90% of annuities never annuitize? I think that's changing right now with the income riders on the annuities. A lot of people that are sold annuities are sold because of the income riders. You notice I say the word sold because I don't think most people would go seeking them on their own. That's changing. The reason the older ones that aren't annuitized, I think people just have them. It's something it's something you don't see and touch in your life, and they just figure I'm just going to pass that on to my beneficiaries. I know it's a common thing that a lot of annuities are not typically annuitized. That's it for questions right now. So what makes LLIS different? Well, when we do these monthly free webinars, our next one coming up in July is leaving a legacy with life insurance. I believe Mark is going to be doing that. We save fee-only financial advisors time and their clients money by pre-underwriting to avoid surprises. And this is talking about life insurance. You can go to some of these quick quote sites online and maybe even get policies issued very quickly. We try to have clients only do things once. So we do a lot of underwriting up front, making sure we're going with the correct company up front. We try to quote as accurately up front because we don't want surprises to come to clients. We're not going to quote a better underwriting class than we believe a client's going to qualify for. We want everything to be up and level as much as possible. We have specialists here. We have specialists for life insurance, disability, long-term care, annuities, and hybrids. I am your annuity specialist. I do dabble in hybrids of life, but I would say my biggest specialty is term insurance. And we are proud sponsors of all these various organizations that are part of your fee-only life. And if you haven't had a chance to use our portal, we call it Alice. It's available 24/7, 365 days a year. It is where all your client sensitive documents are kept. Any quotes that are sent out are done through this. There's nothing going over the web. Everybody has to log into it to see quotes. You can upload documents to us. So if you need me to do an annuity review for you and you don't want to send it just through email, you can upload it to me through our L system. Or if you have an email from me, there's a link in my signature for secure uploads. And that's it. Are there any other questions? All right. Well, everybody, thank you for your time. Have a wonderful evening and stay safe. Bye.